Here at ComLucro, we have refined the ICT Turtle Soup framework into two liquidity models based on the type of liquidity being targeted by the market. The first model focuses on internal liquidity sweeps, where price temporarily sweeps short-term liquidity within a broader range before the main trend resumes. This variation is commonly used as a continuation setup. The second model focuses on external liquidity sweeps, where price attacks a major range extreme, takes external liquidity, and then fails to continue beyond that level. This variation is commonly used as a reversal setup back into the range. The key distinction between these two frameworks is understanding whether the market is targeting internal or external liquidity. Now, let us explain the ICT Turtle Soup setup within the context of an internal liquidity sweep in a bullish scenario. This setup appears when the market is already trending in one direction. Instead of reversing the entire range, price forms a temporary pullback, sweeps internal sell-side liquidity during that retracement, creates a fake change of character or fake market structure shift, and then resumes the main bullish trend. In this context, the Turtle Soup setup becomes a continuation entry rather than a full reversal, as shown in the chart example. Here, we are not looking for a random liquidity sweep. We are looking for a turtle soup condition forming within an internal range liquidity sweep context. This means price is still trading inside a broader range structure, but temporarily trades below an important internal low before reclaiming the range. The key idea is that the sweep itself is not the entry signal. The sweep only confirms that liquidity resting below the lows has been taken. What matters next is whether price fails to continue lower after the sweep and starts showing signs of bullish reversal on the lower time frame, creating a bullish lower time frame change of character or market structure shift. After that, within our framework, we apply a Fibonacci retracement to the impulsive move and place a buy order at the 50% retracement level. The stop loss is placed below the structure low, while the targets are divided into two levels. The first target is positioned at a 1-to-1 risk-to-reward ratio, and the second target aims for the most recent higher high on the higher time frame. The same logic applies to the bearish scenario, with all conditions inverted. Now, let us go to the chart, put everything together, and walk through how to identify the ICT Turtle Soup setup within the context of an internal liquidity sweep in a bullish scenario, step by step. On a bullish scenario, and within an internal range liquidity sweep context. First, start on a higher time frame, in this case, the 1 hour. In the bullish scenario, your focus is sell-side liquidity, because that is where long stops tend to rest, below clear lows. Mark the most obvious levels, such as recent swing lows, previous day low, or previous week low. Then, once those liquidity areas are marked, wait for price to sweep that sell-side liquidity and close back above the level, returning inside the range. In many cases, this will appear as a candle that trades below the low and then closes back within the range, signaling a failed breakdown. However, in fast market conditions, this return can happen quickly and without much consolidation. After that, move down to your lower time frame, in this case the 5-minute. This is the time frame you will use for execution, not for prediction. Here you wait for a bullish market structure shift or a bullish change of character, meaning price starts to break above a key lower time frame swing high after the sweep, showing that bearish control is weakening. Here at ComLucro, we prefer to apply a Fibonacci retracement after the market structure shift occurs. Keep adjusting the retracement as price develops, and place a pending entry order at the 50% retracement level, targeting the nearest higher time frame buy-side liquidity. The same logic applies to the bearish scenario, with everything inverted. Now, the framework we just covered can be refined even further by incorporating fair value gaps into the execution process. Instead of relying only on the liquidity sweep and structural shift, we can use fair value gaps to identify more precise entry locations aligned with the underlying liquidity narrative. By combining market direction, liquidity manipulation, and imbalance-based execution, the setup evolves from a simple liquidity sweep into a more structured institutional framework. A high-probability bullish turtle soup setup occurs when price raids liquidity below a recent swing low while remaining positioned above a bullish fair value gap. In this case, the market sweeps sell-side liquidity, triggering stops from retail traders, but holds above a key demand imbalance. Similarly, a bearish turtle soup forms when price raids liquidity above a recent swing high while resting below a bearish fair value gap, signaling that buy-side liquidity has been collected before a potential move lower. Now, how do we approach execution? In this example, we clearly see an established uptrend, which means we are only interested in buying opportunities. The first reaction might be to place a buy limit directly at the visible demand zone. On the surface, this area appears to be a strong entry point. However, as smart money traders, we understand that this is exactly where many retail participants will enter long and place their stop losses just below the structure. This creates a strong probability of manipulation at that level, as the market often dips below the obvious demand zone to target sell-side liquidity before continuing higher. If you analyze the left side of the chart, you can also identify a bullish fair value gap that acts as a more refined demand zone. This imbalance provides a cleaner and more strategic location for entering a long position, aligned with liquidity logic rather than emotional entries. To properly trade the turtle soup setup, in a bullish scenario, we wait for price to sweep the liquidity below the swing low and then observe signs of rejection near the fair value gap. The key is patience. The liquidity raid below the low is designed to trigger sell-side stops and trap breakout sellers. Once price returns back inside the prior range after the raid, we can execute a buy position with our stop loss placed safely below the manipulated zone. From there, we target the next significant level ahead of price, typically a liquidity pool or structural high aligned with the prevailing trend. Now, in the bearish scenario, the same logic applies but in reverse. We wait for price to sweep liquidity above a recent swing high, and then watch for rejection near a bearish fair value gap. This move above the high often traps breakout buyers and collects buy-side liquidity. Once price drops back inside the prior range, we can open a sell position with our stop loss placed safely above the manipulated zone. The target then becomes the next important level below price, usually a sell-side liquidity pool or structural low aligned with the broader bearish direction. Now, let us explain the ICT Turtle Soup setup within the context of an external liquidity sweep in a bullish scenario. This setup appears when the market is already trending bullish and approaches an important external range high. Instead of continuing higher after the breakout, price sweeps external buy-side liquidity above the range extreme, triggers breakout traders and stop losses, and then quickly fails back below the level. In this context, the ICT Turtle Soup setup becomes a reversal entry rather than a continuation setup, as shown in the chart example. Here we are not looking for a random liquidity sweep. We are looking for a turtle soup condition forming at an external range extreme. This means price temporarily trades above a major high, takes the liquidity resting above the range, and then reclaims the previous structure after failing to sustain the breakout. The key idea is that the sweep itself is not the entry signal. The sweep only confirms that external liquidity resting above the highs has been taken. What matters next is whether price fails to continue higher after the sweep and starts showing signs of bearish reversal on the lower time frame, creating a bearish lower time frame change of character or market structure shift. After that, within our framework, we apply a Fibonacci retracement to the impulsive move and place a sell order at the 50% retracement level. The stop loss is placed above the structure high, while the targets are divided into two levels. The first target is positioned at a 1-to-1 risk-to-reward ratio, and the second target aims for the most recent lower low on the higher time frame. The same logic applies to the bearish scenario, with all conditions inverted. In an ICT Turtle Soup setup, within the context of an external liquidity sweep in a bullish scenario, the setup forms when a trending market temporarily fails after sweeping an important range extreme. First, start on a higher time frame, in this case the 1 hour, and identify a clear bullish structure with higher highs and higher lows. In this scenario, your focus is buy-side liquidity resting above the recent highs, where short stops and breakout entries tend to accumulate. Price often makes a shallow pullback, sometimes not even forming a clear higher low, and then pushes above the previous high. This move sweeps buy-side liquidity above the high, triggering stops and attracting late breakout buyers. Then, instead of continuing higher, price fails to hold above the high and starts to reverse, signaling that the breakout was false and that liquidity has been taken. After that, move down to your lower time frame, in this case, the 5-minute. This is the time frame you will use for execution, not for prediction. Here, you wait for a bearish market structure shift or a bearish change of character on the lower time frame. This occurs when price breaks below a key internal swing low after the sweep, showing that bullish control is weakening and that price is no longer accepting higher levels. Here, at ComLucro, we prefer to apply a Fibonacci retracement after the market structure shift occurs. Keep adjusting the retracement as price develops, and place a pending entry order at the 50% retracement level, targeting the nearest higher time frame sell-side liquidity. The same external range logic applies in a bearish market as well, with everything inverted. So trader, please remember that the ComLucro channel is focused on giving traders clarity, confidence, and structure. And this Smart Money Concept series is designed to do exactly that. Each video breaks down one ICT concept in a clear and practical way, helping you understand how price behaves, where liquidity forms, and how market structure develops. If this explanation helped you see the market with more clarity, make sure to check the full Smart Money Concepts playlist linked on the card and in the description, where all these ideas are organized step by step into a complete learning path.